Hi, I'm Sheila Darby, a Managing Director here at Bizworth. Thank you for joining me for today's video on how to value a business. We're looking at the income approach. This is part one of a two-part video on the income approach. As a reminder, there are three generally accepted valuation approaches to valuing a business. The first is the asset approach. We covered this approach in a previous video. The second is the income approach, and the third is the market approach. And today's video, part one and part two, are both going to be focused on the income approach. So what exactly is the income approach? The income approach is focused on valuing a business based on the future anticipated economic benefits, such as cash flows. So future anticipated cash flows generated from your business. And it's focused on those future benefits, discounting back to a present value, a single amount for your business. So when do you want to use this approach? There are lots of good examples as to when this approach is preferred. However, as a certified professional valuator, we consider every approach every time. So we're going to look at the asset approach, the income approach, and the market approach every time. And one or more of those approaches may be applicable to your particular business. So for a business using the income approach, a valuator that's going to apply the income approach, we're particularly looking at businesses that are profitable. So if your business is profitable, the income approach is a great valuation approach. So if your company has been generating losses for the last several years, the income approach may not be a very insightful method. Valuations for tax returns and for the IRS, again, the income approach is very insightful. But some of the helpful things about the income approach is that it's very specific to your company. And so we look at the earning capacity of your company. We look at the growth potential of your company. We look at any large capital expenditures of your company. So it's very specific to your company and the future earning capacity of your company. And so we'll cover the approach and the methods in more detail in these videos. But now that we've decided that the income approach is appropriate for your business, how do we go about using it? If you think an auto mechanic may have lots of different tool chests, and in each one of those tool chests or toolboxes, he's going to have lots of tools. You can consider the approaches to valuing your business, the three different approaches, the asset, the income, and the market, as different toolboxes or tool chests. And the tools that we have in each one of those boxes are the different methods that we use. So in the income approach, there are many different methods we can use, but this video, we're going to focus on two particular methods. We're going to focus on the capitalization of earnings method, and sometimes that's referred to as the capitalization of cash flows method. And the second is the discounted earnings method, or otherwise known as the discounted cash flow method. And again, that's sometimes referred to as DCFs. So we're going to cover these two different methods. In this part one video, we're going to cover the capitalization of earnings, and in the part two method, we're going to cover the discounted cash flow method. So the capitalization of earnings method, what exactly is it? Again, it's focused on the future estimated benefits or the future estimated cash flows of your business. And we're looking at what's being generated from your business, and then it's going to be the cash flow is going to be capitalized using an appropriate capitalization rate. Again, this is all specific to your business. The important thing to know about the capitalization of earnings method at a high level is that this is a particularly useful method to use within the income approach for businesses that may be considered to be in a fairly steady state. That means they're earning roughly the same economic benefits or cash flows year in and year out. There may be a marginal growth increase or a decline year over year, but they're somewhat in steady state. And so what would be a great example? Let's talk about a manufacturing business that Bizworth looked at several years ago. And I myself worked on this particular case, a good manufacturing business. And the business itself generated several $1 million in revenues. But on average, the 5-year weighted average, just to let you know, each year this particular business generated very similar cash flows after tax basis on an after tax basis. And so the 5-year average of this particular manufacturing company was $591,000. And after doing the analysis on the appropriate rate for this type of business, it was determined that the appropriate rate was 21% roughly. I think here it was 21.32%. And we could probably have a multi-part video on just the high level basics on what it is to take an appropriate discount rate or capitalization rate. But for the sake of not diving too much into discount rates, we're going to assume that it is 21.32% for this particular manufacturing company. We're also, to keep things simple, we're going to assume 0% growth. And on average, growth rates, the way we determine growth rates, we look at the company, we look at the historical growth of the company, we look at the industry in which the company operates. We also look at the economic conditions, both short-term, mid-term, and long-term. And there's lots of resources that we pull upon for those growth rates. But how we valued this particular company, we'll call this company generically ABC Company, but it was really a long-standing manufacturing business that was well diversified, had lots of different clients, and very good earnings history over the years. But in this particular case, how we went about the math was the capitalization of earnings, the indicated value, again, the 5-year average on an after-tax basis was $591,000. And then we took that appropriate rate of return for this particular business, which was 21.32%. And you take that and you use that to divide into the 591,000. And you come up with an indication of value of roughly $2,772,000 for this particular manufacturing business. The math is fairly straightforward. The science and the art of it comes into understanding all the different methods which are appropriate for this given business. And because this business had been in business for many years and their historical after-tax earnings and cash flows were relatively at a steady state, their capital expenditures were fairly at a predictable steady state, depreciation was at a steady state, the capitalization of earnings method was a great method to use for this particular company. And the math is very straightforward. It's taking the capitalization of earnings in this case, it's the after-tax basis of earnings, and dividing it by the appropriate rate, which here was 21.32%. So I hope you found this example helpful. I hope it will help you when you're considering all the different appropriate methods that might be appropriate for your company and understanding what those are. But the valuation of a company is complex. And if you're trying to use evaluation or for negotiations, for estate planning, for family law matters or business litigation, you're going to want to have a certified professional because your valuation will have a tremendous amount of credibility. And if you have any questions, don't hesitate to reach out to BizWorth. You can reach us at www.bizworth.com. But stay tuned for the next video number 2. We're going to pick up with the discounted cash flow method after this one. Thanks for tuning in to this part 1.